Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vale stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vale is a mining and logistics company. It is the largest producer of iron ore and nickel in the world. It also produces manganese, ferroalloys, copper, bauxite, potash, kaolin, and cobalt. The company is headquartered in Rio de Janeiro, Brazil, and was founded in 1942. The ticker trades on the New York Stock Exchange, Spanish Bolsa, Sao Paulo Stock Exchange, Mexican Bolsa, Deutsche Börse, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 86 billion market cap. They're trading at $18 a share, and they have 4.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. In 2019, their free cash flow was $8.4 billion, and then it grew to $21 billion in 2021. It's still over $16 billion in the trailing 12 months. Commodity prices have gone through the roof, and companies like this and their investors have benefited. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's over $21 billion in the trailing 12 months. Revenue is the sales for the company, and that grows a lot as well, from 38 billion to 53 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that gross profit grows a lot, from 16 billion up to 31 billion. Then you have your operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And you can see their operating income more than doubled from 2019 to the trailing 12 months. But their revenue only increased 30% from the same time period. So their margins are through the roof. That's why they pay such a high dividend. They spent only $700,000 of interest on their debt, which is a lot lower than 2019 of $2.6 billion. They also spent $400 million on financing costs. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. In 2019 and 2020, they had large asset impairments. That's why their net income was so low those years. But their net income is really high in 2021 and the trailing 12 months, over 21 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. Then you have capital expenditures, investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. Since they have so much more free cash flow than prior years, they're paying a really big dividend. So if you own this stock within the last 12 months, you're receiving a really nice dividend. In 2021, they bought back $5.5 billion of stock. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. They also paid down over $1 billion of debt, because they added $900 million of debt and paid down $2.1 billion. So they decreased their debt load over $1 billion. Let's look at their capital structure. 38 billion of equity, 18 billion of debt. They're 67% equity, 33% debt. And their net debt is 9.2 billion. I gave them a WACC of 12%. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 100 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $106 billion. We divide that by 4.7 billion shares. And we get a calculated stock price of $22. They're trading at $18, so they're trading at a 19% discount. It's a buy according to the model. Their revenue target for 2024 is 209 billion Brazilian reais. To convert that number to US dollars, you can just divide by 5. So that equals about 44 billion US dollars. Their revenue target in 2023 is 47 billion. In 2022, it's 53 billion. And I continued this trend into 2025 and I got about 41 billion. That's how I got their future revenue estimates. They convert on average 30% of their revenue into free cash flow, so I multiplied their future revenue estimates by 30%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $16. They're saying it's 14% overvalued. 8 analysts priced this stock and the average price target is $20. The lowest $14, the highest $23. This is where the stock has been trading the last 5 years. It bottomed out at $7 when COVID hit in March 2020. Then the stock price tripled, hitting about $23 a share. Then over the next 2 months, the stock was cut in half. And due to the commodity super cycle, it shot way up past $20. And then it fell to about $16. Now it's back up to $18. So you can see the stock moves around a lot. This bottom chart is the price of iron ore for the past 5 years. So you can see this company's stock price pretty much tracks iron ore. It's not exactly, but it's really close. So if you want to know where this stock price is going, you can just track the price of iron ore. Here's a history of the company's dividends. They were paying about 60 cents per share back in 2011 and 2012. Then they dropped it to 40 cents. Then it fell to as low as 5 cents. But look how much their last dividend payment was, $1.56. And just 3 months before that, they gave you 44 cents. 3 months before that, 77. And 3 months before that, 46. If you sum up these last 4 dividend payments, take that number and divide by the stock price, that gives you a yield of almost 18%, which is 71% of their net income, 95% of their free cash flow. Here's a chart of their dividend yield since 2011. In 2011, it was about 4%. Then in 2015, it was about 9%. Then it dropped a lot in 2016, 17, 18, 19, and 20. But it's really shot up in 2021 and 2022. But it's pretty much impossible for a company to pay a double-digit dividend for an extended period of time. The forecast is for their dividend yield to be 7.2% by 2024. The last stock split they did was 15 years ago, a 2-for-1. Then in 2006, a 2-for-1, and 2004, a 3-for-1. Their beta is 0.72, so the stock is less volatile than the market. It's gone down 19% in the past 52 weeks, while the S&P is down 1%. The 52-week low is 11, the high is 23. And the stock is on an uptick, trading above its 50-day and 200-day moving average. And this stock gets a lot of activity. Well over 30 million shares are traded each day. Of the 4.7 billion shares outstanding, 4.3 billion are on float, 24% are held by institutions, and 0.6% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you would have been in the red for about 8 years. But if you're still holding on, you'd be at $16,000 today. That's a 60% return, a 5% annual return. 73% of the company is held by institutions, 17% by the general public, 10% by public companies, and a small percentage by private companies and employees. The biggest shareholder is Capital Research at 27%, then Banco do Brasil, BlackRock, Mitsui, and the Brazilian Development Bank owns 4%. Let's look at their financial ratios. Look at this PE, 4.0. That's stock price over earnings per share. Price to sales of 1.6, price to book of 2.3, and an unbelievable price to free cash flow of 5.3. That's stock price over free cash flow per share. They have a low return on invested capital of 3.5%. They can cover their interest payments 3 times. A really high ROE of 57%, and they have a good current ratio of 1.3, that's current assets over current liabilities, and a quick ratio of 1.0. In the trailing 12 months, they generated over 16 billion of free cash flow. They have 4.8 billion of working capital, and they pay out over 15 billion in dividend payments. So the company's really well funded. The best way to look at ratios to compare them to companies in the same industry, there are 64 companies in the same industry as Vale. And if Vale has number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a lot on CapEx, a lot more than average, a little less than BHP, a lot less than Rio. Their debt to equity ratio is a little worse than average. They pay a really high dividend, If you own BHP, Rio, or Vale, you were receiving a really nice dividend in the past 12 months. They generate less cash flow than BHP or Rio. They rank third in market cap, a lot smaller than BHP, a little smaller than Rio. But the reason their price multiples are so much better than BHP and a little better than Rio is because they're a Brazilian company. Their 5-year annual revenue growth rate is 15%, and they have a really high ROA and ROE. So to summarize, I have them trading at a 19% discount, but when will the super cycle end? I know a lot of my subscribers were annoyed they missed the big run-up from 2020 to 2021. But with all the political unrest and the high inflation, there still could be lots of opportunities with this company. I rank their free cash flows 9 out of 10, their revenue 9 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.